I'm Clara Hermit and this is Mould on Markets, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
Very well, Clara. Looking very festive, may I say?
Well, it is the season, isn't it?
It is the season to be jolly, yes.
What is it that advisors and their clients should be thinking about right now?
Okay, well, 2014 ends. It's time to look to the next 12 months, especially as we seem to be ending this year on a bit of a bum note. And so, trying to pick through the bones of the end of the year, the three key themes for me for 2015 are the dollar, dividends, and debt.
I know we've talked about it a lot recently, but let's start with the mighty dollar.
Mighty dollar. Well, the first chart behind us shows King Dollar in 2014 against a trade-weighted basket, and the buck's bounce is suggesting one of two things. The markets are pricing in a US interest rate increase, in contrast to what we're seeing, say, in Japan or Europe, or investors' appetite for risk is falling, or potentially both. Now, a sustained increase in 2015 in the dollar could have massive implications. The dollar bull run of the 1980s coincided with financial carnage in Latin America, and the advance of the 1990s caused all sorts of chaos in Asia. On each occasion there was a dollar bull run, emerging market sovereigns and companies found themselves struggling to service their dollar-priced debts. Now, emerging market countries are in much better shape than they were 20 or 30 years ago, but corporates have borrowed very heavily, as issuance in the corporate credit market will tell you. Now, the second chart behind us makes clear the inverse or negative correlation between the dollar and the MSCI Emerging Markets Equities Index.
All right, so that's the dollar. Should we move on to dividends?
Yes, dividends, all important, lovely income. In the end, many clients are relying on a dependable income from their savings. Record low bond yields and interest rates hardly help here, but perversely, they are supporting stock markets, or certainly have been in 2014, owing to a shortage of alternative income sources. Now, great care still needed here. According to estimates for 2015, the FTSE 100 offers a yield of around 4%. That's £72 billion of dividend payments, by the way. But the next two charts show the source of those dividend payments, or at least expected by consensus. Now, financials are expected to pay up a quarter of total dividends, the first chart, and in the second chart, around a half of dividend growth in sterling terms is also expected to come from financials. Now, the Bank of England stress tests may provide some reassurance here, but clients must study this area to make sure earnings and free cash flow dividend cover for those payments are robust and the payment forecast reliable. And if they haven't got the time, and let's face it, who does, at least get a decent income fund manager to do the donkey work for them.
All right, let's move on to the final topic then, debt.
Yeah, it's not going anywhere. I hate to talk about this at Christmas, but despite government's efforts to cut spending and boost growth, the 16th Geneva report on the world economy reveals that the global debt to GDP ratio has gone up since 2007 from 176 to 214%, excluding financial companies borrowing, so the real number's probably higher still. Now, this debt pile and the associated interest payments could continue to smother growth. It also explains why central banks and governments want to keep interest rates at historically low levels to help them fund the debts and the interest payments, and also let some inflation erode their value in real terms. Now, the final chart behind us shows rates across the EU, US, UK and Japan. Trend's pretty clear. All the way down to historic lows, and they're still there. Now, Japan's cranking up quantitative easing. Europe's gradually moving towards such a plan in a bid to keep those rates low and get credit flowing. Europe and Japan still struggling to grow under the burden of their debts, and their policies could diverge from those of the US and the UK, who are expected to increase rates rather than tighten rather than loosen in 2015, even if inflation and low growth may mean any hikes are small and slow to come.
Okay, thank you, Russ.
Thank you.
And a big thank you to you for watching. Wishing you a very Merry Christmas.
Merry Christmas.
A Happy New Year. Bye-bye.